Good morning, everyone. Welcome back to the channel. It's February 9th, 2026, and after last week's sharp rebound, S&P closing at 6,932, Dow crossing 50,000 for the first time, NASDAQ up over 2% on Friday. Markets are looking resilient again. But today we're talking about something important from our ongoing project discussions and the latest Hedgeye insights. This is not a full bear case yet, but the signals are shifting, and it's time to prioritize risk management. Let me explain why in the next 5 minutes. Right now, we're still in or transitioning toward what Hedgeye calls Quad 1 Goldilocks, accelerating growth plus decelerating inflation. That regime has been supportive. Fed easing hopes, disinflation continuing, AI productivity tailwinds, and rotation out of megatech into value, small caps, and even some international names. That's why we saw the strong bounce last week, and why markets are hovering near all-time highs again. But Hedgeye is forecasting a regime change ahead. Quad 4 in Q2, slowing growth plus slowing inflation, and then Quad 3 in Q3, slowing growth plus sticky or re-accelerating inflation, classic stagflation vibes. Quad 4 is typically a risk-off environment. High beta growth in tech underperform defensive sectors like healthcare and utilities start to lead volatility picks up. VIX tend to rise. Pullbacks and corrections become more frequent. Then Quad 3 adds another layer. Multiple compression on equities inflation sticks around even as growth slows commodities, and gold can act as hedges international and emerging markets sometimes hold up better due to dollar weakness. This is not a doom and gloom call for a full bear market. Hedgeye still sees constructive elements in the front half, growth acceleration, policy support, earnings momentum. But mid-year the regime shift introduces real caution. This lines up perfectly with what we've been discussing in the project. Markets historically spend 85 to 93% of trading days below all-time highs. We're in one of those below 88 grinds in many sectors right now. Narrowing breadth, stretch valuations, S&P PE near 26x, and AI spending scrutiny. Remember Microsoft's 10% plunge on CapEx fears. Volatility is creeping higher again, and policy/geopolitical noise, tariffs, Fed independence concerns can make any regime transition feel sharper. So what does this mean for how we approach the rest of 2026? It's not about going full bearish. It's about risk management. 3 simple pillars we keep coming back to. Diversification, lean into areas that can perform in shifting regimes. Value and small caps, already showing relative strength. Foreign stocks and international dollar devaluation trade still in play. Defensives when needed commodities like gold as a hedge. It's been swinging wildly but holding long-term. Hedging volatility position size appropriately. Respect big drops from all-time highs. Our project system rule of thumb. Go to cash or reduce on significant breakdowns, like minus 20% from peak, and only re-enter on confirmed full recoveries. That discipline protects capital during the choppy Quad 4 and Quad 3 phases. Patience in the grind of market does most of its real work below peaks. Sideways moves, consolidations, and corrections are completely normal. Avoid chasing euphoria at the highs. Wait for clarity on the next regime. Bottom line, 2026 is still constructive in the near term thanks to Quad 1 momentum, but the shift toward Quad 4 in Q2 and Quad 3 in Q3 means tightening the risk belt mid-year makes sense. Diversify, hedge the volatility, and stay patient during the inevitable grinds. That's the balanced view we're tracking in the project right now. What are you doing to manage risk as we head into spring? Adding defensives? Watching gold? Focusing on international? Drop your thoughts in the comments below. If this helped clarify the outlook, hit the like button, subscribe for more updates from our project, and turn on notifications so you don't miss the next one. Thanks for watching. Stay sharp, stay patient, and I'll see you in the next video.